Before we begin, please remember that this presentation is for informational and educational purposes only. I am not a licensed financial advisor, and the information provided in this video does not constitute financial, legal, or professional advice. The home loan process is complex and varies based on individual circumstances and location. Always consult with a qualified mortgage professional, financial advisor, and real estate attorney before making any major financial decisions. Your financial situation is unique, and you need advice tailored specifically to you. You found it. The perfect house. The one with the wraparound porch you've always dreamed of. The kitchen that looks like it's straight out of a magazine. The backyard big enough for a dog and a swing set. Your heart is racing. This is it. This is the one. But there's a huge, terrifying hurdle standing between you and those front door keys. The mortgage. And because the market is white hot, you need to get it approved, and you need to get it approved fast. The seller has other offers, the clock is ticking, and the pressure is immense. Now, what if I told you that nearly 1/3 of all initial mortgage applications are denied? Not because the person couldn't afford the house. Not because they had terrible credit. But because they made simple, completely avoidable mistakes during the application process. These are the kinds of mistakes that don't just delay your dream. They can shatter it completely, sending you right back to square one while another family moves into your home. This isn't just another video with a boring list of tips. This is your battle plan. This is your guide to navigating the minefield of a quick home loan application. Over the next several minutes, we are going to dissect the 10 most common, most catastrophic mistakes that sabotage aspiring homeowners. We're not just going to tell you what they are. We're going to show you why they're so deadly to your application and give you the exact strategies to sidestep them with precision. By the time you finish this, you will have the knowledge and the confidence to move through this process like a pro, turning a stressful ordeal into a smooth, successful path to homeownership. You will learn how to protect your credit, structure your finances, and present yourself to a lender as the perfect, most reliable candidate they've seen all week. So let's get straight to it. The very first mistake is perhaps the most common, and it's born from the pure excitement of buying a new home. We call it the pre-closing shopping spree. Sounds so innocent. You've been pre-approved. You've found the house. Your mind is already decorating. You start thinking, you know what would look perfect in that new living room? A brand new sectional sofa. Or, that 2-car garage is begging for a new car to go in it. So you head to the furniture store, you see a no interest for 24 months deal, and you swipe the card. Or you visit the car dealership and drive off in a new SUV. In your mind, you're just getting ready for your new life. In the lender's mind, you just detonated a bomb in the middle of your financial profile. Let me be crystal clear. From the moment you decide to apply for a mortgage until the day you have the keys in your hand and the deed is recorded, you must consider your financial life to be in a complete and total lockdown. You do not make any large purchases. You do not open any new lines of credit. You don't finance a new laptop. You don't even apply for a new department store credit card to save 15% on new towels. Nothing. Your financial picture must remain as static and boring as humanly possible. Here's exactly why that celebratory shopping spree is so catastrophic. It attacks your application from 3 different angles. First, and most importantly, it wrecks your debt-to-income ratio, or DTI. Think of your DTI as your financial blood pressure. It's a simple percentage that shows how much of your monthly gross income goes toward paying your monthly debts. If you make $5,000 a month and you have $2,000 in total debt payments, student loans, car payments, credit cards, your DTI is 40%. Lenders have very strict DTI limits. It's their primary tool for measuring risk. They need to be certain you have enough cash flow left over after paying your debts to comfortably afford your new mortgage payment plus taxes, insurance, and, eating. When you go out and finance a $1,500 sofa, you've just added a new monthly payment. It might only be $100 a month, but that $100 nudges your DTI upward. When you finance a $30,000 car, you might have just added a $500 monthly payment. That doesn't just nudge your DTI, it sends it skyrocketing. I once saw a deal fall apart a week before closing because a perfectly qualified buyer bought a high-end riding lawnmower for their new 1-acre lot. The $75 a month payment pushed their DTI just over the lender's 43% threshold. The loan was denied. They lost the house over a lawnmower. Second, applying for new credit triggers hard inquiries on your credit report. When you apply for a car loan or a store card, that lender pulls your full credit history. This is called a hard pull. and each one can temporarily ding your credit score by a few points. One inquiry isn't a disaster, but if you're shopping around for a car at 3 different dealerships and applying for financing at 2 different furniture stores, you suddenly have 5 new hard inquiries on your report. To an underwriter, this is a massive red flag. It makes you look desperate for credit. It signals financial instability. They start asking, why does this person suddenly need access to so much new debt right before taking on the biggest debt of their life? It creates uncertainty, and uncertainty is the enemy of loan approval. Remember, lenders repull your credit report right before funding the loan. They will see that new car loan. They will see those inquiries. There is no hiding it. And third, it can deplete your cash reserves. Lenders don't just look at your debt. They want to see that you have cash in the bank. They call it assets. They need to verify you have enough for the down payment, the closing costs, and a buffer for emergencies after you move in, usually a few months' worth of mortgage payments. If you suddenly make a huge $5,000 cash withdrawal to buy furniture, the underwriter will see that. Your bank statements are under a microscope. That sudden drop in your savings account can make them question if you'll have enough to close, or if you'll be house poor from day one. Spooks them. I knew a couple, let's call them David and Jessica. They were pre-approved, sailed through the initial underwriting, and their closing was set for a Friday. The weekend before, they went out and bought a whole suite of brand new appliances for their new kitchen. They paid with the new credit card from the big box store to get the promotional financing. On Wednesday, the lender did their final credit check, a standard procedure called a credit refresh. The new account and the $10,000 balance popped up. The lender hit the brakes. The loan had to be completely re-underwritten with the new debt payment factored in. Their DTI was now too high. The closing was canceled. They had to beg the sellers for an extension, frantically pay off the new credit card with money they had earmarked for repairs, and resubmit everything to the lender. It was a week of pure, unadulterated stress and panic. They almost lost the house because of a refrigerator. So what's the unbreakable rule? It's simple. Put on your financial blinders. Your one and only financial goal is to close on that house. Everything else can wait. That new sofa will still be there in a month. The car dealership will still be running sales after you've moved in. Your mantra is, if I can't pay for it in cash, and it's not a life or death emergency, it does not exist. Your debit card is your friend. Your checkbook is your friend. Credit applications are your sworn enemy. The excitement is real, and the temptation to start nesting is powerful, but you have to resist. Delay that gratification for just a few more weeks. It will be the difference between getting the keys to your dream home and getting a soul-crushing phone call from your loan officer. But here's the scary part. Avoiding new debt is only half the battle. The next mistake we're going to cover is even more insidious because it has nothing to do with spending money. In fact, it's about the money you're receiving. It's a trap that thousands of well-intentioned, honest people fall into every single month. And it all starts with a simple, innocent-looking cash deposit into your bank account. Let's call them David and Jessica. For 5 years, they lived on a strict budget. They brown-bagged their lunches, skipped expensive vacations, and David did freelance web design on the weekends, always getting paid in cash. Jessica worked as a server at a high-end restaurant, and every single night, she'd come home and put her cash tips into a big glass jar. That jar was their dream home fund. Over the years, it grew and grew. It was a physical, tangible symbol of their sacrifice and their discipline. When they finally found the perfect little bungalow, they counted the money. An incredible $25,000. All in cash. Feeling a huge sense of accomplishment, they took their jar of cash to the bank and made the deposit. Their account balance swelled. Felt amazing. They had the down payment, they had great credit, they had stable jobs. They submitted their loan application with confidence, including their freshly printed bank statement showing a healthy balance. They thought they had done everything right. A week later, they got an email from the underwriter. An underwriter, by the way, is the person at the bank whose entire job is to look for risk. They are the final gatekeeper. The email was short and pointed. It requested a letter of explanation for the $25,000 cash deposit, along with sourcing documentation. David and Jessica froze. Sourcing documentation? For cash they'd saved over 5 years? How do you document that? Do they send a picture of the empty glass jar? Do they get notarized letters from every customer who ever gave Jessica a tip? Their excitement turned to pure panic. This is mistake number 2. Making large undocumented cash deposits right before or during the loan process. To you and me, depositing your hard-earned savings is a logical step. To a mortgage underwriter, a sudden large cash deposit is a five-alarm fire. It's one of the biggest red flags in the entire mortgage world. And the reason why goes deep into the rules that govern banking. Lenders are legally required by federal law, including the Patriot Act, to verify the source of all funds used for a down payment. They have to prove to the government that the money isn't from illegal activities like money laundering, and just as importantly, that it isn't an undisclosed loan. Think about it from their perspective. They see 25 grand appear out of thin air. Their first thought isn't, wow, what great savers. Their first thought is, where did this money really come from? Is it a secret loan from a relative that David and Jessica will have to pay back? Because if it is, that's an extra monthly debt that wasn't disclosed on their application. That new, secret debt payment could be the straw that breaks the camel's back, pushing their debt-to-income ratio too high, and making them a much riskier borrower. The lender has no way of knowing if it's savings or a secret loan. And in the world of lending, the unknown equals risk, and risk equals denial. So what happened to David and Jessica? Their loan process screeched to a halt. They spent 2 agonizing weeks trying to prove where the money came from. They wrote a passionate letter explaining their 5-year savings plan. Jessica got a letter from her restaurant manager confirming she earned significant tips. David tried to track down freelance clients from years ago. It was a nightmare. The underwriter was skeptical. The $25,000 was unseasoned. That's the key word here. Seasoned. Lenders want to see seasoned funds. This means the money has been sitting in your bank account for a certain period of time, usually at least 60 days or 2 full bank statement cycles. When money is seasoned, the lender doesn't have to question its origin. It's just your money. By depositing their cash right before applying, David and Jessica made it unseasoned. And in doing so, they created a massive unnecessary headache that jeopardized the entire deal. They were asked for more documents, more proof, and every request caused a delay. Meanwhile, the seller of their dream home was getting impatient. This is a heartbreakingly common scenario. So how do you avoid it? First, if you are a cash saver, you need to plan ahead. Way ahead. The moment you start even thinking about buying a home in the next year or two, you need to change how you handle your cash. Start making regular, small deposits into your savings account. Don't wait until you have a huge pile. Deposit it as you earn it. This creates a pattern of behavior that the lender can see and understand. A consistent history of small deposits is infinitely better than one giant, shocking deposit. Second, if you do have a large sum of mattress money saved up, get it into the bank at least 3 months before you even talk to a lender. Deposit it and then don't touch it. Let it sit there. Let it season. After 2 full bank statement cycles have passed, that money is now part of your established financial history. It's no longer a red flag. It's just an asset. But what if it's too late? What if you're like David and Jessica and you've already made the deposit, and you're applying for a loan next week? All is not lost, but you need to get proactive. The key is documentation and communication. If a portion of that money was a gift from a family member, you need to handle it properly. The person giving you the money needs to sign a formal gift letter. This is a standard document that your loan officer can provide. It explicitly states that the money is a gift, not a loan, and that there is no expectation of repayment. The giver will also need to provide their bank statement showing the money coming out of their account. Yes, it feels intrusive, but it creates the paper trail the underwriter needs to see to check that box and move on. If the money came from the sale of a large asset like a car or a boat, you need the bill of sale. You need a copy of the check or wire transfer, and you need to show that deposit matching the sale price exactly. You have to connect the dots for the underwriter so they don't have to guess. And it's not just physical cash. In today's world, this applies to large unexplainable transfers from Venmo, Zelle, or PayPal. If your buddy pays you back $2,000 for a vacation you covered, that transfer could raise the same questions. The solution is the same documentation. In the memo line of the transfer, have your friend write reimbursement for Vegas trip. It seems silly, but that little note can be the difference between a smooth process and a 2-week delay. The fundamental rule is this: every dollar for your down payment and closing costs must have a clear, documented, and legitimate source. The underwriter's job is to tell the story of your money. If there are mysterious gaps in the story, they can't approve the loan. By making a large cash deposit, you're essentially handing them a book with a missing chapter and asking them to trust that the story still makes sense. They won't. David and Jessica, after weeks of stress and almost losing the house, were eventually able to satisfy the underwriter. But the experience completely drained the joy from their home buying journey. They learned a hard lesson. In the mortgage world, how your money looks on paper is just as important as how much money you have. Your bank statements for the 60 days leading up to your application are under a microscope. They need to be as clean and boring as possible. No sudden large deposits, no mysterious transfers, no unexplained movements of money. Getting your finances in order is the first battle. You've avoided the cash deposit trap. Your down payment is seasoned and sitting pretty. You feel prepared. You're ready. But then you walk into your office and your boss calls you in for a meeting. He's thrilled with your performance and offers you a promotion. It comes with a new title and a big raise. You're ecstatic. This is amazing news. It will make the mortgage payment even easier. You immediately call your loan officer to share the good news, expecting them to be just as thrilled. But instead, there's a long, uncomfortable silence on the other end of the line. Because you just accidentally triggered a landmine that could blow up your entire home loan. And it's a mistake that punishes people for getting ahead in their careers. That landmine has a name, and it's called unstable income. And it's one of the most frustrating, counterintuitive, and downright infuriating hurdles in the entire mortgage process. Because in the real world, your new job is a massive step up. It's the promotion you worked for, the career change you dreamed of, the entrepreneurial leap you finally had the courage to take. It's a testament to your ambition and success. But in the black and white, backward-looking world of mortgage underwriting, it's a giant, flashing red question mark. The lender on the other end of that phone isn't hearing, "I got a promotion with massive upside." They're hearing, "Everything you thought you knew about my ability to pay you back just went out the window." Let's be brutally clear about what's happening here. Mortgage lenders are not in the business of betting on your future potential. They are in the business of verifying your past performance. Their entire model is built on one word: predictability. They want to see a long, boring, and incredibly consistent track record of you earning money. When you tell them you just started a new job 2 months ago, you've just shattered that predictability. Imagine this scenario. You were a marketing manager making a solid, stable $85,000 salary for the last 5 years. Predictable, boring, perfect. But you're a rock star, so you just got headhunted for a new role as a director of sales. The new job has a base salary of $60,000, but it comes with a commission structure that could easily push your total income to $150,000, maybe even $200,000 a year. You're ecstatic. You've more than doubled your earning potential. You call your loan officer, bursting with pride, and tell them the good news. And that's when you hear the silence. Because the underwriter, the person in a back room who holds your file and your future in their hands, can't use that potential. They can't use your excitement. They can't use your boss's word that you're going to crush it. They can only use what they can document from the past. And what they see is that you voluntarily took a $25,000 pay cut. That's it. In their eyes, your income just dropped from $85,000 to $60,000. Your commission, that's just a fantasy until you have a 2-year history of earning it. This is the 2-year rule, and it is the bane of every ambitious homebuyer's existence. For any income that isn't a fixed salary or hourly wage, lenders demand to see a 24-month history of you receiving it. This applies to commissions, bonuses, overtime, and especially self-employment or freelance income. They will take your last 2 years of tax returns, add up all that variable income, divide it by 24, and use that monthly average to qualify you. If you've only been earning that type of income for 6 months, to them it's 0. 1 year, 0. 23 months? It might as well be 0. You could have a signed contract promising you $1 million bonus next year. And for the purposes of your mortgage application today, it is worth exactly 0. This trap ensnares so many people who are making smart career moves. Think about the registered nurse who's been working at a hospital for years, earning a steady $75,000. She decides to become a travel nurse because the pay is incredible. Her first 6-month contract pays her the equivalent of $140,000 a year. She's killing it. She finds her dream home, applies for a loan, and gets denied. Why? Because she switched from a W-2 salary job to a 1099 independent contractor role. Her stable income history is gone. The bank now sees her as a brand new, self-employed business owner with only a 6-month track record. They won't even look at her application until she has 2 full years of tax returns as a travel nurse. She was punished for doubling her income. Or what about the software engineer who leaves his cushy job at a tech giant to start his own consulting firm? He lands 3 massive clients in his first year and bills $300,000. He's tripled his old salary. But when he goes to buy a house, the lender looks at his 1 year of business income and says, "This is great, but it's not stable. We don't know if you'll do it again next year. Come back when you have another year of tax returns to prove it." He was punished for building his own successful company. The mistake here isn't getting the better job. The mistake is the timing. It's applying for the loan after the change, not before. If you are even remotely thinking about buying a home in the next 2 years, and you are also considering a career change that will alter how you are paid, you need to pick one. Either buy the house now while your income is simple, stable, and documented. Lock in that mortgage. Then go take the new job, chase that commission, start that business. Or accept that if you take the new job first, you are resetting the clock on your home buying journey. You are likely putting yourself in a 2-year holding pattern, no matter how much more money you're actually making. Now, are there exceptions? Sometimes, but they are rare and you should never ever bank on being one. If you're moving from one commission-only job to another in the exact same industry with a 5-year track record, a lender might be able to make it work. If your new salary job includes a bonus, and the employer can provide a written guarantee of a certain minimum bonus, they might be able to use a portion of it. But these are fringe cases that require a ton of extra documentation and a very experienced loan officer who knows how to fight for you. For the vast majority of people, the 2-year rule is ironclad. So what's the takeaway? The number 1 rule of applying for a home loan is to make your financial life as boring as possible for at least 6 months leading up to your application, and especially during the process itself. Don't change jobs. Don't change how you're paid. Don't go from W-2 to 1099. Collect your predictable pay stubs and let them paint a picture of unwavering stability. The time for bold career moves is after you have the keys to your new house in your hand. So you've navigated this income minefield. You've learned your lesson. You've stayed at your boring, stable job. Your paychecks are as regular as the sunrise. You feel confident. Your loan officer has pre-approved you based on your solid 2-year income history. You're ready. So you decide to do something responsible, something every financial guru on the planet tells you to do to improve your finances. You decide to consolidate your debt. You see an offer for a personal loan with a 7% interest rate, and you realize you can use it to pay off your 3 credit cards that are all charging you over 20% interest. It's a brilliant move, right? You're lowering your monthly payments, saving a ton on interest, and simplifying your life. Your credit score is about to skyrocket. It's the most fiscally responsible thing you've done all year. Except you just mailed the underwriter a handwritten confession that you're a massive credit risk, and it could cost you your entire loan. How? By doing something that feels completely logical. Something your parents probably told you to do. You closed a credit card. Maybe it was that old department store card you haven't used in 5 years. Maybe it was your very first credit card from college with a tiny limit and a silly picture on it. You thought, "I'm about to take on a mortgage, the biggest debt of my life. I need to be responsible. I need to simplify. I need to get rid of temptations and clean up my financial house." So you called the bank, you snipped the card in half, and you felt a wave of adulting wash over you. You were tidying up. But in the eyes of a mortgage underwriter, you didn't just tidy up. You took a lit match to a crucial part of your financial resume. And it all comes down to 2 boring-sounding terms that are the secret language of lenders: credit utilization ratio and length of credit history. Let's tackle credit utilization first. Imagine your total available credit is a big bucket. Let's say you have 3 credit cards, each with a $10,000 limit. Your bucket can hold $30,000. Now let's say across all those cards you have a total balance of $3,000. Your bucket is only 10% full. You look fantastic. You look like someone who has access to a lot of resources but uses them sparingly and responsibly. You are a low-risk borrower. Now you decide to clean up. You close that one card you never used, the one with the $10,000 limit. Suddenly, your bucket isn't a $30,000 bucket anymore. It's a $20,000 bucket, but you still have that same $3,000 balance. Now, you're not using 10% of your available credit. You're using 15%. Overnight, your credit utilization ratio jumped by 50%. You didn't spend a single extra penny, but you instantly look more leveraged. You look riskier. The underwriter doesn't see your good intentions. They see a number on a screen that just got worse. Their algorithm flashes a little warning light. They see someone whose financial buffer just shrank. What if you had a real emergency next month? You have less available credit to handle it. You're closer to being maxed out. To a lender, being closer to the edge is a terrifying prospect. They're not just lending you money for a month. They're betting on your stability for the next 30 years. And you just signaled that your stability is decreasing. But that's only half the damage. The second, and often more devastating, blow comes from something called length of credit history. Your credit score isn't just about paying bills on time. It's about proving you can do it over a long period. Lenders are like cautious partners looking for a long-term relationship. They want to see your relationship history. A long, stable history with credit is incredibly attractive. It shows predictability. It shows you're not a flight risk. That old, dusty credit card you just closed? The one you got in college to buy textbooks and pizza? That was likely your oldest account. It was the anchor of your entire credit file. The average age of all your accounts is a major factor in your FICO score. Let's say you had that college card for 15 years, another card for 5 years, and a car loan for 2 years. The average age of your accounts is a healthy 7.3 years. You look established. You look seasoned. When you close that 15-year-old card, it's gone. It's like erasing your longest-running job from your resume. Now, your only active accounts are 5 years old and 2 years old. Your average age of credit plummets to just 3.5 years. You've just cut your credit history's age in half. To an underwriter, you suddenly look like a rookie. You went from being a seasoned veteran of the credit world to someone who looks like they just got started. All that history, all those years of on-time payments on that old account, lose their powerful influence. The lender thinks, wait a minute, this person's profile just got a lot younger, a lot less proven. Why? What's changed? Are they trying to hide something in that older account history? It creates uncertainty, and uncertainty is the enemy of a mortgage approval. When you combine these two factors, a higher credit utilization and a shorter credit history, your score can take a nosedive. We're not talking 1 or 2 points. We're talking a potential drop of 20, 40, even 80 points depending on your specific profile. And this happens at the worst possible time. You're in the middle of the loan process. The lender might have pre-approved you based on your 760 credit score. But they always do a final credit check right before closing called a credit refresh. Imagine their surprise when they pull your report again and see you're now a 710. The alarm bells don't just ring, they scream. The loan that was practically guaranteed is now on life support. The interest rate they quoted you? That was for a 760 score applicant. For a 710, the rate is higher, significantly higher. That one decision to close a card could now cost you tens of thousands of dollars over the life of the loan in extra interest. Or worse, it could push your debt-to-income ratio just over the line, and you could get an outright denial. A week before you were supposed to get the keys to your new home. So what's the right move? It's counterintuitive, but you need to treat those old cards like treasured artifacts. Keep them open. Don't use them for major purchases, but don't let them die either. The best strategy is to put one small recurring bill on each of them. A $5 coffee subscription. A $10 streaming service. Something you can set to autopay and forget about. This does 2 magical things. First, it keeps the account active so the bank doesn't close it for inactivity. Second, it reports positive, on-time payment history to the credit bureaus every single month. You're actively building a stronger and longer credit history without taking on any meaningful debt. You're proving you can juggle multiple lines of credit responsibly. You're keeping your credit utilization low by maintaining that high total credit limit. You're preserving the age of your credit history. You are, in short, curating the perfect financial resume for the underwriter to review. The goal during the mortgage process is to be as boring and predictable as possible. You want your financial life to be a flat, calm ocean. Closing a credit card is like dropping a boulder in the middle of it. It creates waves and ripples that make lenders very, very nervous. I worked with a client once, a young doctor finishing his residency. He was meticulous. He read every article, followed every rule. He thought he'd do his lender a favor by closing 2 retail cards he got for a discount on scrubs years ago. He wanted to show he was shedding frivolous debt. His score, which was a pristine 810, dropped to a 750 in a week. The bank didn't deny him, but the drop knocked him out of their top-tier interest rate bracket. The rate difference was only 0.25%, but on an $800,000 loan for his new home, that 0.25% translated to over $120 a month. Every month. For 30 years. That's more than $43,000 in extra payments over the life of the loan. All because he tried to do the responsible thing. So you've resisted the urge to tidy up. Your old credit cards are open. humming along with a tiny subscription purchase. Your credit score is stable, a beautiful high number that lenders love. You're feeling confident. You're on the home stretch. And then your parents, overjoyed you're buying a house, decide to help. They hand you an envelope with $20,000 in cash for your down payment. It's a dream come true. A gift that makes everything easier. So you drive to the bank, you hand the cash to the teller, and you watch your account balance swell. You just solved your down payment problem. Except you've just created an entirely new one. You've handed the underwriter a giant undocumented mystery, and you may have just triggered a federal-level inquiry into your finances. Let's unpack that, because to you it's a gift from a loving family member. To an underwriter, it's thousands of dollars of mattress money. Unsourced, unseasoned, and completely anonymous. And in the world of mortgage lending, anonymous money is the single biggest red flag you can raise. Why? 2 words: Patriot Act. After September 11th, federal regulations were put in place to track the movement of large sums of money to prevent terrorism financing and money laundering. Your mortgage application is not exempt from this. In fact, it's on the front lines. The lender is legally required to verify the source of every single dollar you use for your down payment. When a giant pile of cash just appears in your account, the lender can't prove where it came from. They can't prove it's not from an illegal source, and more importantly for them, they can't prove it's not just an undocumented loan from a friend. Think about it from their perspective. If your Uncle Bob gave you $20,000 as a gift, but he secretly expects you to pay it back with interest every month, that's not a gift. That's a debt. It's a debt that doesn't show up on your credit report, and a debt that absolutely affects your ability to pay your mortgage. Your debt-to-income ratio, the very foundation of your approval, is now built on a lie. The underwriter's job is to sniff out that lie. They are financial detectives, and you just handed them a case with no paper trail. So what's the right way to do it? How do you accept a generous gift without blowing up your home loan? You document everything with obsessive precision. The process is simple, but it is non-negotiable. First, the person giving you the money, the donor, needs to sign a formal gift letter. This is a standard document your loan officer can provide. It explicitly states the donor's name, your name, the exact dollar amount, the property address, and the most important sentence of all. This is a bona fide gift, and there is no expectation of repayment. But the letter alone isn't enough. You need to prove the donor actually had the money to give. They will need to provide a bank statement showing the funds leaving their account. And you need to show the corresponding deposit into your account. The numbers must match perfectly. And here is the pro tip: do not move cash. Ever. The money should move from their bank account to your bank account via a trackable method like a wire transfer or a cashier's check. This creates an unbreakable digital paper trail that makes an underwriter smile. No questions, no mysteries, no red flags. Just a clean, documented transfer of funds from a legitimate source. Seems like a lot of hassle, but it's the only way. You are asking a bank to lend you hundreds of thousands of dollars based on a snapshot of your financial life. That snapshot has to be crystal clear. Large cash deposits are like a giant smudge on the lens, and the lender will simply choose not to take the picture. Okay, so you've navigated the down payment maze. Your money is seasoned. Your gift funds are documented. You've submitted your paperwork, and you've received the magic words. You are pre-approved. Feels like you've crossed the finish line. You're practically a homeowner. You start browsing for furniture. You notice your old car is looking a little shabby for that new 2-car garage. You see a 0% financing deal on a brand new sectional sofa, or a great lease special on that SUV you've always wanted. You think, the hard part is over. I can afford the monthly payment. What's the harm? The harm is catastrophic. This is mistake number 6, and it might be the most heartbreaking of them all. Making a major purchase or changing your credit profile after pre-approval. That pre-approval letter feels like a golden ticket, but it's not. It's a provisional offer based on your financial situation at that exact moment in time. It comes with a massive unwritten asterisk that says, as long as absolutely nothing changes. And when you finance a new car or a living room set, you are fundamentally changing everything. Here's what happens behind the scenes. Right before you close on the house, typically within a few days of the closing date, the lender does what's called a soft pull or a credit refresh. They are not just rechecking your score. They are looking for new activity. They want to see if you've taken on any new debt since you were pre-approved. When they see that new $500 a month car payment, alarm bells go off all over the building. Why? because that $500 just blew your debt-to-income ratio to smithereens. Let's say your DTI was at 42%, tight but acceptable. That new car payment could easily push you to 46 or 47%, which is an automatic denial from the underwriting system. The loan that was approved is now rejected. It also lowers your credit score. When you apply for that car loan or that store credit card, it triggers a hard inquiry on your credit report, which can ding your score by a few points. But more importantly, opening a new line of credit lowers the average age of your accounts, which is a key factor in your credit score. A drop of even 10 points can be enough to change your interest rate or disqualify you for the loan program entirely. And finally, if you paid for the item in cash, you've just reduced your cash reserves. Lenders want to see that you have enough money in the bank to cover the closing costs and a few months of mortgage payments as a safety net. If you just spent $10,000 on new furniture, your safety net is gone, and from the lender's perspective, you are now a much riskier borrower. The result is a phone call from your loan officer that you will never forget. They'll tell you the loan has been denied, just days before you were supposed to get the keys. Your moving truck is booked. You've already given notice to your landlord, but the deal is dead. You lose the house. And worse, you will almost certainly lose your earnest money deposit, which could be thousands or even tens of thousands of dollars, all for a new sofa or a new car. So what's the rule? From the moment you get pre-approved until the moment the keys are physically in your hand, you must become a financial ghost. You enter a self-imposed financial lockdown. Do not buy anything on credit. Do not finance a car. Do not buy furniture. Do not open a new credit card, even if they offer you a 20% discount at the checkout counter. Do not co-sign a loan for anyone, not even your own mother. Your financial life must be frozen in carbonite. And here's a piece of advice that sounds completely wrong, but is critically important. Do not make any large, unusual payments on your existing debts without talking to your loan officer first. You might think, I'll pay off this old $300 collection account, that will look good. No, it won't. Paying off an old collection can sometimes update the date of last activity on your credit report, making an old negative item look new again, which can actually cause your score to drop temporarily. The system is bizarre, but it's the system we have. So you don't change anything. You just continue to make your normal, on-time payments on your existing accounts. Nothing more, nothing less. Your job is to get to the closing table with the exact same financial snapshot you started with. Any deviation, any new purchase, any change at all, puts the entire transaction at risk. You can buy all the furniture you want the day after you close. On that day, you can drive your brand new car into your brand new garage, but not 1 second before. Because that pre-approval isn't a promise, it's a test. And the only way to pass is to do absolutely nothing. And doing nothing is the hardest thing you'll ever have to do. But this rule only applies after you get that pre-approval letter in your hand. Before that moment, before you commit, it's the exact opposite. You need to be incredibly active. In fact, before you lock in with a lender, there's one thing you absolutely must do. And it's something nearly half of all homebuyers in America simply fail to do. And this single failure, this one oversight, could easily be the most expensive mistake of their entire lives. We're talking about the colossal mistake of not shopping around for your mortgage. Think about it. When you buy a television, you check prices at Best Buy, Amazon, maybe even Target. You spend hours reading reviews to save $50. When you buy a car, you visit multiple dealerships, you haggle, you pit one offer against another to save $1,000, maybe $2,000. You would never ever walk into the very first dealership you see, point at a car and say, I'll take it at whatever price you tell me. That would be insane. So why on earth would you do that for the single largest purchase you will ever make? A purchase that's 100 times more expensive than a car? Yet it happens every single day. People get a recommendation from their real estate agent, or they just walk into the bank where they've had a checking account since they were 16, and they sign on the dotted line without ever knowing what they're leaving on the table. It's a phenomenon I call the loyalty tax. You feel loyal to your bank, but your bank's primary loyalty is to its shareholders. Their job is to make a profit, and the easiest way to do that is to bank on the fact that you won't check their competitors. The other reason people don't shop around is fear. The mortgage process is intimidating. It's a mountain of paperwork and confusing jargon, and the first lender who gives you a pre-approval feels like a lifeline. You just want the stress to be over. And there's a huge myth that paralyzes people. The myth that applying with multiple lenders will destroy your credit score. We're going to shatter that myth to pieces in a minute, because it's costing people a fortune. But first, let's talk about what a fortune actually looks like. Let's make this real. We tend to think of interest rates in tiny little fractions. What's the big deal between 6.5% and 6.25%? Sounds like nothing. It's a quarter of a percentage point. It's pocket change. But on a mortgage, that pocket change is a slow, silent leak that will drain a river of cash out of your bank account over the next 30 years. Let's do the math. Imagine you're getting a $400,000 home loan. Lender A, your comfortable, familiar bank, offers you a 30-year fixed rate of 6.5%. You think, great, I'm approved, and you're ready to move on. But you decide to do your due diligence. You call 2 other lenders. Lender B offers you 6.375%. And Lender C, a local credit union, offers you 6.25%. Let's compare Lender A to Lender C. That's a difference of just 0.25%. At 6.5%, your monthly principal and interest payment is about $2,528. At 6.25%, your monthly payment is about $2,462. The difference is only $66 a month. You might think, okay, $66. That's a couple of nice lunches out. Not life-changing. But you're not paying that mortgage for 1 month. You're paying it for 360 months. $66 a month times 360 months equals $23,760. Let that sink in. By making 3 phone calls, by spending a couple of hours filling out applications, you could have saved nearly $24,000. That is a brand new car. That is an entire year of a child's college tuition. That is a kitchen remodel. It is a life-changing amount of money that you're willingly handing over to the bank, simply because you didn't shop around. And that's just for a quarter-point difference. What if the difference was a half point? You're suddenly looking at over $47,000 in savings. Are you willing to work for several years of your life just to give that money away? Because that's the trade you're making. So, how do you do this correctly? The goal is to compare offers from at least 3 to 5 different types of lenders. Don't just call 5 big national banks. You need to diversify. First, talk to a big national bank. A Chase, a Bank of America, a Wells Fargo. They're big, they're stable, and sometimes they have competitive rates, especially if you're an existing customer with a lot of assets. Second, talk to a local community bank or a credit union in your area. These smaller institutions often have more flexibility, better customer service, and sometimes surprisingly better rates because they have lower overhead and are deeply invested in the local community. They want your business. Third, and this is the one most people miss, talk to a mortgage broker. A mortgage broker is fundamentally different from a loan officer at a bank. A loan officer at Bank A works for Bank A. Their job is to sell you Bank A's products. A mortgage broker, on the other hand, works for you. They are a middleman who has access to dozens of different wholesale lenders, many of whom you've never even heard of. Their job is to take your single application and shop it around to all of those lenders to find the absolute best rate and terms for your specific situation. They do the shopping for you. When you get offers from these lenders, you're not just comparing the interest rate. You need to ask for an official loan estimate. This is a standardized 3-page government form that every lender is required to give you. It was designed specifically to help you compare loan offers on an apples-to-apples basis. It breaks down everything: the interest rate, the monthly payment, and, crucially, all the lender fees. These are the origination fees, application fees, underwriting fees, and other junk fees that are bundled into Section A of the loan estimate. Sometimes a lender will offer a super low interest rate, but then pack the loan with thousands of dollars in extra fees. The loan estimate exposes this. You line them up side by side and you can see instantly who is truly offering the best deal, not just the most attractive sounding rate. Now let's tackle that fear. What about your credit score? Isn't applying with 5 lenders going to result in 5 hard inquiries that will tank your score right when you need it most? The answer is an emphatic no. This is one of the biggest and most damaging myths in personal finance. The credit scoring models, whether it's FICO or VantageScore, are smart. They know the difference between someone going on a wild, irresponsible spending spree applying for 10 different credit cards, and someone who is prudently shopping for a single major loan like a mortgage or a car loan. For this reason, they have something called an inquiry window. All mortgage-related hard inquiries that occur within a specific period of time are treated as a single inquiry for scoring purposes. Depending on the specific FICO model being used, this window is typically between 14 and 45 days. So you can, and absolutely should, apply with all 3, 4, or 5 of those lenders within a 2-week period. Your score will see it as one single event. The impact will be minimal and temporary, a few points at most, which is a tiny, insignificant price to pay for the potential to save tens of thousands of dollars. The credit bureaus are literally giving you a free pass to shop around. Not taking advantage of it is financial malpractice. So you've shopped around. You've pitted lenders against each other. You've used one offer to negotiate a better deal with another. You've secured the lowest rate and the best terms. You've locked it in. You're feeling brilliant. You're in the clear, right? You've avoided the big financial traps. Wrong. Because now you're about to face a tidal wave of fees that can completely sink your home purchase if you're not prepared. It's an ambush of expenses that blindsides almost every first-time homebuyer. It's a financial iceberg called closing costs, and most people only see the very tip before it rips a hole in their savings and their dreams. So let's talk about that iceberg, because it's not just one big fee. It's a swarm of them, a death by 1,000 paper cuts, each one taking a slice of the savings you fought so hard to build. Closing costs are the collection of fees required to finalize your mortgage and transfer the home's title into your name. Think of it as the cost of doing business. It's the payment for the entire army of people who work behind the scenes to make your home purchase happen: the lender, the appraiser, the title company, the local government, and more. And here's the critical million-dollar distinction that so many people miss. These costs are completely separate from your down payment. You save for the down payment. You budget for the down payment. You dream about the down payment. But the closing costs? They sneak up on you in the final weeks, demanding their own separate and very large check. So what exactly are you paying for? Let's pull back the curtain. Imagine you're at the closing table. The first set of hands reaching for your wallet belongs to your lender. These are called lender fees. You'll see things like an origination fee or an underwriting fee. This is essentially the bank's fee for creating the loan. It's their payment for the mountain of paperwork, the risk assessment, the background checks, and the salary of the person who stamps approved on your file. It's their administrative payday. Next up, you have the third-party fees. This is where the list gets long and confusing. First, there's the appraisal fee. Before a bank lends you hundreds of thousands of dollars, they need independent proof that the house is actually worth that much. So they hire an appraiser to inspect the property and determine its market value. You pay for that appraiser's time and expertise. Then there's the home inspection fee. This one is for you, not the bank, but it's often paid at closing. This is you hiring a detective to search for every hidden flaw: the leaky roof, the faulty wiring, the cracked foundation. It's your best defense against buying a money pit. Then comes one of the most important, yet least understood costs: title search and title insurance. This is non-negotiable. A title company dives deep into the property's history, scouring public records to make sure the person selling you the house actually has the legal right to sell it. They're looking for ghosts in the property's past: unpaid taxes from a previous owner, a contractor who put a lien on the house for an unpaid bill, or even a long-lost heir who could suddenly appear and claim ownership. The title search is the investigation. The title insurance is your financial shield that protects you and the lender forever if they miss something and one of those ghosts comes back to haunt you. Without it, you could be paying a mortgage on a house you don't legally own. You'll also see attorney fees or closing agent fees. This is the person conducting the closing, the maestro of the final ceremony, making sure every document is signed, every dollar is accounted for, and the transfer of ownership is legally binding. And don't forget the government. They want their cut too. You'll pay recording fees to the county clerk's office to officially update the public record, screaming to the world, "This house is now mine." But wait, there's more. The final category is what's known as prepaids. These aren't fees for services. They are you paying for certain housing expenses in advance. You'll likely need to prepay for your first full year of homeowner's insurance. The bank insists on this because they won't risk their investment on a property that could burn down tomorrow and be uninsured. You'll also have to prepay a few months' worth of property taxes, which are held in an account called escrow. Essentially, you're giving the bank a cushion to ensure your taxes get paid on time every time. And if your down payment is less than 20%, you'll probably have a prepaid mortgage insurance premium here as well. So, how much does this financial iceberg actually cost? The national average for closing costs is between 2% and 5% of the home's purchase price. That sounds small. It is not. Let's do the math on a $400,000 home. At 2%, that's $8,000. At 5%, it's a staggering $20,000. Let that sink in. You've just spent years scraping together $40,000 for a 10% down payment. You're proud, you're excited, you're ready. Then, a few weeks before closing, you get a document that says you need to show up with your $40,000 down payment, plus another $15,000. Your stomach plummets. Your heart races. Where is that supposed to come from? This is the moment where deals fall apart. This is the ambush. The mistake isn't that closing costs exist. The mistake is walking into the ambush completely unprepared. So how do you avoid it? You go on the offensive. The moment you apply for a loan, the clock starts ticking. By law, a lender must provide you with an official loan estimate within 3 business days. This document is your battle plan. It is your secret weapon. It is a detailed line-by-line breakdown of your estimated closing costs. This isn't a vague guess. It's a legally regulated document that the lender must honor within certain tolerances. Your job is to treat this document like gold. When you get it, turn straight to page 2. You'll see the costs broken into sections. Some, like the appraisal and credit report fees, are set in stone. You can't shop around for those. But then you'll find a section, usually section C, titled Services You Can Shop For. This is where you can fight back. This section includes things like the title search, title insurance, and pest inspection. The lender will provide a recommended provider, but you are absolutely not required to use them. You have the right to shop around for these services. Call 3 or 4 different title companies. Get quotes. Compare prices. You can save hundreds, sometimes even over $1,000 just by making a few phone calls. Don't just passively accept the numbers on the page. Next, you can get the seller to help you. This is a strategy called seller concessions or seller credits. In your purchase offer, you can ask the seller to contribute a certain percentage or dollar amount towards your closing costs. Why would they do that? Well, in a competitive market, it can make your offer more attractive. Let's say you want to buy that $400,000 house, but you're short on cash for the $15,000 in closing costs. You could offer the seller, say, for $110,000 for the house, but ask for a $10,000 credit back at closing to be used for your costs. The seller gets the price they want, and you get to finance a huge chunk of your closing costs into the loan itself, dramatically reducing the cash you need to bring to the table. It's a powerful negotiating tool that most first-time buyers don't even know exists. You can also ask your lender about lender credits. This is a trade-off. The lender might agree to pay for some or all of your closing costs, but in exchange, you'll accept a slightly higher interest rate on your loan. This can be a great option if you're short on cash now, but it means you'll pay more over the life of the loan. You have to do the math. If you plan on staying in the house for 30 years, it's probably a bad deal. But if you're low on funds and think you might sell or refinance in 5 to 7 years, it could be the perfect solution to get you into the house without draining every last penny from your savings. The biggest key is to be proactive. When you get that loan estimate, don't just glance at the final number and file it away. Go through it, line by line. If you see a fee you don't understand, circle it. Call your loan officer and say, "Can you explain the title services endorsement fee to me? What is it for and is it required?" A good loan officer will patiently walk you through everything. A bad one will be evasive or annoyed. And that alone tells you everything you need to know about who you're trusting with the biggest financial transaction of your life. Closing costs are the submerged, invisible part of the home buying iceberg. The down payment is just the tip you see above the water. Ignoring what's underneath, what's lurking in the fine print, is how your dream of homeownership sinks right before you reach the shore. You've done it. You've navigated the closing cost iceberg. You've shopped around, you've negotiated, and you've got the cash ready. You're days away from getting the keys. Everything looks perfect. But then you get a call from your lender. The words hit you like a punch to the gut. There's a problem with your file. Your loan, which was fully approved, is now on hold. Or worse, it's been denied. At the last second, your world collapses. How could this happen? It happens because of one of the most common, yet most devastating mistakes a buyer can make in the final stretch. A mistake that turns victory into gut-wrenching defeat right at the finish line. That mistake is called celebrating too early. It's the belief that once you have that commitment letter, once you have that clear to close, you've crossed the finish line. You haven't. You're in the final, most treacherous 100 yards of the marathon, and this is where most people stumble. So what did our buyer do? What was the phone call about? Simple. 2 weeks before closing, excited and seeing the finish line, they walked into a car dealership. Their old beater had been on its last legs for years, and they thought, "We're getting a new house, let's get a new car to go with it." A new life. They put a few thousand down and financed a brand new $40,000 SUV. The monthly payment? $650. They didn't think twice. Their credit was great, they got approved instantly. They drove off the lot feeling like they were on top of the world, picturing their new car in the driveway of their new home. What they didn't know is that they had just signed the death warrant for their home loan. That frantic call from the loan officer wasn't a courtesy. It was a panicked SOS because in the final days before closing, lenders do something called a soft pull on your credit and a final verification of your employment and assets. They are rerunning the numbers one last time to make sure nothing has changed. They are making sure the person they approved a month ago is the exact same person, financially speaking, that they are about to wire hundreds of thousands of dollars to. And when they reran the numbers for our buyer, a giant flashing red light appeared on their screen. A new $650 monthly debt payment that wasn't there before. This brings us to the most critical yet poorly understood number in the entire home loan process: your debt-to-income ratio, or DTI. Imagine a seesaw. On one side you have your gross monthly income. On the other side you have all your monthly debt payments. Student loans, credit card minimums, car payments, and your proposed new mortgage payment. For the seesaw to be balanced or for you to get approved, the debt side can't be too heavy. Most lenders want that debt side to be no more than 43 to 45% of the income side. Some go up to 50, but it gets risky. When our buyer was first approved, their DTI was a healthy 42%. They were safely under the limit. But when they added that $650 car payment to the debt side of the seesaw, bam, the seesaw crashed to the ground. Their DTI shot up to 49%. Suddenly, from the lender's perspective, they were a much riskier bet. The carefully constructed financial profile that got them approved had been shattered. The loan was denied. The deal was dead. And their earnest money? Gone. All for a new car they now had to park in the driveway of the apartment they thought they were leaving. This is the 8th major mistake. Making any major financial changes between pre-approval and closing. It's not just buying a car. This is a minefield of seemingly innocent decisions that can detonate your dream. Think of the period from your loan application to the moment the keys are in your hand as a financial silent run. You need to become a ghost. Let me be crystal clear about what this means. Do not apply for new credit of any kind. That means no new credit cards. Even the store card that offers you a 20% discount on the new washer and dryer you're eyeing for the house. Don't do it. That credit inquiry alone can ding your score, and the new line of credit, even with a zero balance, can affect your DTI calculations. Do not co-sign a loan for anyone. Not for your kid who needs a car for college, not for your sibling, not for your best friend. When you co-sign, their debt becomes your debt in the eyes of the lender. That $500 car payment your nephew is making? It just landed on your side of the DTI seesaw, and it could sink your mortgage. Do not change jobs without talking to your lender first. This is a huge one. You might get a better job offer with a $10,000 raise. You think, this is great. This will make me an even better candidate. Wrong. Lenders hate instability. They love to see a consistent 2-year job history. If you switch from a salary W-2 job to a commission-based role, or become a 1099 contractor, you could be instantly disqualified, raise or not. Even moving to a new company in the same industry can raise red flags. The only way to navigate a job change during this period is to talk to your loan officer before you even think about accepting the offer. They can tell you exactly how it will impact your loan and what documentation you'll need. Don't surprise them. Surprises in the mortgage world are never good. Do not move large amounts of money around. Lenders source and season your funds. They want to see that the money for your down payment has been sitting in your account for at least a couple of months. If your rich uncle suddenly wires you $20,000 for a gift, it has to be documented perfectly, with a gift letter and proof of the source of his funds. A large undocumented cash deposit looks like a secret, undisclosed loan to an underwriter, and they will hunt it down. Don't just transfer your life savings from one bank to another without a clear paper trail. Keep everything stable. Do not pay off old debts or close credit card accounts. This sounds counterintuitive, right? Shouldn't I pay off my collections to look better? Not necessarily. Paying off an old collection account can sometimes cause a temporary drop in your credit score, as it updates the activity date on a negative account. Closing a long-held credit card, even with a zero balance, can also hurt your score by reducing your average age of accounts and increasing your credit utilization ratio. The rule is simple. If it wasn't a problem when you got pre-approved, don't try to fix it now. Leave it alone. Think of it this way: from the moment you apply for that loan, you are under financial surveillance. The lender has taken a snapshot of your life, your job, your income, your debt, your credit, your assets. Their entire approval is based on that single perfect snapshot. Your one and only job is to remain perfectly still until the process is over. You must be the same person on closing day that you were on application day. No new purchases on credit. No new loans. No new jobs. No mysterious cash. Become boring. Become invisible. Your financial life needs to go into a self-imposed lockdown. Now you might be thinking, but what if I have an emergency? What if my car literally dies and I can't get to work? What if my refrigerator breaks and I need a new one? These are valid concerns. Life happens. The solution isn't to sneak around and hope the lender doesn't notice. The solution is communication. Your loan officer is your partner in this, not your enemy. If you have a legitimate emergency that requires a major purchase or a new line of credit, you call them first. You explain the situation. You ask them, how can we do this without jeopardizing the loan? They can run the numbers with the new potential debt. They can tell you exactly how much of a monthly payment you can afford to take on. They might advise you to buy a cheaper used car with cash, or to wait and use a small portion of your savings. They can guide you through the minefield because they know the map. What they can't do is reverse the damage after you've already signed the paperwork for that new car. By freezing your financial life and communicating everything with your lender, you eliminate the single greatest cause of last-minute loan denials. You take control of the process and ensure that the person who shows up to the closing table is the same person the bank agreed to lend a fortune to. You did all the hard work to get here. You saved the down payment, you polished your credit, you found the perfect house. Don't let a moment of impulse, a premature celebration, turn your dream into a cautionary tale. But here's the scary part. What if you do everything right? You become a financial ghost. You don't buy anything, you don't change jobs, you communicate perfectly. You are the model applicant. And still days before closing, the whole thing implodes. But this time, the problem isn't with you or your finances at all. The problem is with the house itself. A hidden flaw that no one saw coming. And it's a flaw that can kill a deal faster than any new car payment ever could. This flaw has a name. It's called the appraisal. And the single biggest mistake you can make is not understanding what it is, who it's for, and the catastrophic power it holds over your entire home buying journey. See, when you agree to buy a house for, let's say, for $100,000, the bank doesn't just take your word for it. They don't take the seller's word for it. They hire an independent third-party appraiser to go out to that property and determine its true fair market value. And here's the critical part most people miss. The appraisal isn't for you. It's for them. It is the bank's insurance policy. They are about to lend you hundreds of thousands of dollars, and they need to know that if you default on the loan and they have to foreclose the asset, the house itself, is valuable enough to cover their loss. They are making sure the collateral is worth the risk. So let's go back to our perfect scenario. You did everything right. Your credit is stellar, your debt-to-income ratio is a thing of beauty, you have your down payment saved. You find the perfect house, you make a strong offer of $400,000, and in this competitive market the seller accepts. You're ecstatic. You're picking out paint colors in your head. The loan is moving through underwriting smoothly. Then the appraisal report comes back. And your loan officer calls with that hesitant tone in their voice. The house, only appraised for $380,000. Instantly, the deal is on life support. This is what's known as an appraisal gap. In this case, a $20,000 gap. And this is where the dream turns into a nightmare, because the bank will only lend you money based on the appraised value, not the purchase price you agreed to. So, if they were going to lend you 80% of the home's value, they are now only willing to lend you 80% of $380,000, not $400,000. That $20,000 difference? That gap? It's now your problem to solve. Suddenly, you're faced with a handful of terrible options. Option 1. You come up with an extra $20,000 in cash, on top of your down payment and closing costs just to make the deal work. For 99% of buyers, this is impossible. It's a complete deal killer. Option 2. You go back to the seller and try to renegotiate the price down to the appraised value. You can show them the report and say, look, this is what an independent expert says your house is worth. But if it's a seller's market, they might just tell you to take a hike. They might have backup offers and believe someone else will come along, maybe with an all-cash offer where the appraisal doesn't even matter. Option 3. You try to meet in the middle. Maybe you scrape together an extra 10 grand, and you beg the seller to drop the price by 10 grand. This is a painful, stressful negotiation where you have very little leverage. Option 4, you can try to formally challenge the appraisal, but this is a long shot. You have to provide concrete evidence that the appraiser made a significant error or used inappropriate comparable sales, and the process is slow and rarely successful. Or there's the final option. You walk away. If you were smart enough to have an appraisal contingency in your contract, you can cancel the deal and get your earnest money back. But you've lost weeks, maybe months. You've lost the money you spent on the appraisal fee. And you've lost the emotional energy you invested in what you thought was your future home. The whole thing implodes. The mistake wasn't a financial misstep on your part. It was getting caught up in the emotion of a hot market and agreeing to a price that the objective data couldn't support, without having the cash reserves to bridge that potential gap. But let's say you clear that hurdle. The house appraises at exactly your offer price. The bank is happy. You're happy. Everything is on track. But there's another hidden flaw. Another landmine waiting for you. This one isn't about the home's value. It's about its very bones. This is the home inspection. While the appraisal is for the lender, the inspection is 100% for you. It's your chance to hire a professional to crawl into every dark corner of that house and find out what's really going on. They're not looking at cosmetic things like scuffed paint or an ugly carpet. They are looking for the big, expensive, terrifying problems. Is the foundation cracked? Is the electrical panel a known fire hazard? Is there evidence of termites chewing through the support beams? How old is the roof? Is the plumbing made of old, corroded pipe that's about to burst? The mistake people make here is twofold, and both are devastating. The first, and most reckless, is waiving the inspection entirely. In a bidding war, buyers get desperate. They think, if I waive the inspection, my offer will look cleaner and more attractive to the seller. This is the equivalent of playing financial Russian roulette with the biggest purchase of your life. You are willingly buying a multi-$100,000 product completely blind, with no idea if it's a pristine gem or a crumbling money pit about to collapse. But the second mistake is more subtle. It's getting the inspection report and letting your emotions override your logic. The inspector hands you a 40-page report filled with photos of mold in the attic, water damage in the basement, and notes about an HVAC system that's on its last legs. But you're already in love with the house. You love the neighborhood, the kitchen, the big backyard. So you start to downplay the issues. You tell yourself, that crack in the foundation doesn't look that bad. Or, we can probably get another year or two out of that roof. This is how people end up house poor in the worst way imaginable. Not only do they have a mortgage payment, but in the first year of ownership, they're hit with a $20,000 bill for a new roof and a $10,000 bill for mold remediation. Their dream home becomes a financial prison. And this isn't just about your future budget. It can absolutely kill your loan at the last minute. Some government-backed loans, like FHA and VA loans, have what are called minimum property standards. The appraiser, in these cases, does a basic safety and soundness check. If they see major issues like a leaky roof, exposed electrical wiring, or peeling lead-based paint, they can flag it. The lender will then refuse to fund the loan until those specific repairs are made. Now you're in another impossible negotiation. Who pays for major repairs on a house that hasn't even been sold yet? The seller doesn't want to spend thousands on a house they're leaving, and you can't, and shouldn't, pay for repairs on a property you don't even own. The deal grinds to a halt. So the mistake is a failure of due diligence. It's focusing so intently on your own financial paperwork that you forget to scrutinize the single most important part of the equation: the house itself. The appraisal protects the bank's money. The inspection protects your money, your safety, and your sanity. Ignoring the warning signs from either one is like ignoring a doctor who tells you that you have a serious health problem. You can pretend it's not there, but eventually it's going to cause a catastrophic failure. Now imagine you've navigated all of this. You avoided the financial traps. You found a great house. The appraisal came in perfectly. The inspection report was clean as a whistle. You're approved. You're just a few days from closing. The moving truck is booked. The boxes are packed. You're starting to imagine your new life. Then you get a call from your lender. And from the dead silence on the other end of the line, you know something has gone horribly, terribly wrong. This is the final mistake, the one that blindsides people at the finish line. And it's the most heartbreaking of them all. It's called the credit freeze. And no, I'm not talking about locking your credit reports. I'm talking about the period between your loan pre-approval and the moment the keys are actually in your hand. This is the final boss of the home buying process. During this time, which can last anywhere from 30 to 60 days, you are under a microscope. Your lender has given you a conditional approval based on a snapshot of your financial life. They've looked at your income, your assets, your debt, and your credit score, and they've said, okay, based on this specific picture, we will lend you hundreds of thousands of dollars. The critical word there is conditional. The deal is not done. The lender will check everything again. Right before you sign the final papers, they will do a soft pull of your credit. They will call your employer to verify you still work there. They are looking for one thing: did anything change? And the final catastrophic mistake is assuming you're in the clear and changing the picture. You would be absolutely shocked at how many people get pre-approved, find their dream home, sign the initial contract, and then immediately go out and finance a brand new $12,000 living room set, thinking, hey, we need furniture for the new place. Or they decide to upgrade their car because the new house has a 2-car garage. They see those 0% financing for 24 months deals and think it's a no-brainer. What they don't realize is that they just took a financial grenade and tossed it right into the engine of their mortgage application. That new furniture loan? It just jacked up your debt-to-income ratio. That new car payment? It just told the lender's algorithm that you are a riskier borrower than you were 30 days ago. Even opening a new credit card at a department store to save 15% on a new lawnmower can be enough to sink the entire ship. It adds a hard inquiry to your credit report and lowers the average age of your accounts, which can cause your credit score to dip just enough to disqualify you or push you into a higher interest rate bracket. Think about it from the lender's perspective. They agreed to lend you a massive amount of money based on you having, let's say, a 40% debt-to-income ratio. You go buy a new truck and now your DTI is 46%. You've just broken the terms of the agreement. The deal is off. It's that simple, and it's that brutal. The most common killer is a job change. People think, I got a better job, more money. This is great news for my lender. Not necessarily. Lenders worship at the altar of stability. A 2-year history at your current job is golden. If you switch jobs, even for a significant raise, the lender gets nervous. Is this new job stable? Are you past the probationary period? If you switch from a salaried position to one that's heavily commission-based, your application could be thrown out completely, even if your potential earnings are higher. They can't verify future commissions. They can only verify past stable income. Let me tell you about a couple, Michael and Sarah. They did everything by the book. They saved for 5 years. They boosted their credit scores into the high 700s. They got a fantastic pre-approval, found a perfect little starter home in a great school district, and were set to close in 1 week. They were packing boxes, dreaming of painting the nursery. Michael worked in IT, and 2 weeks before closing, he was offered his dream job at a hot new tech startup. It came with a $30,000 raise and incredible stock options. He thought he was setting his family up for life. He accepted the offer and put in his 2 weeks' notice at his old job, but he didn't think to tell his loan officer. Why would he? It was only good news, right? 3 days before closing, the lender did their standard final verification of employment. They called Michael's old HR department. The HR rep, following protocol, said, Michael's last day with the company is this Friday. The phone on the lender's end went silent. Red flags shot up everywhere. Alarms went off. To the underwriter, it didn't look like Michael got a new, better job. It looked like Michael was about to be unemployed. The loan was immediately suspended. Michael and Sarah were thrown into a panic. They scrambled to get an offer letter and employment verification from the new company, but the startup's HR was slow to respond. The closing date arrived, and the financing was not in place. They had breached their contract. They lost the house. And worse, they lost their $20,000 earnest money deposit. 5 years of saving vanished in 72 hours, all because of an unreported good decision. So here is the single most important piece of advice for the entire home buying process. From the moment you are pre-approved until the moment you have physically signed the last document at the closing table, you must enter a state of complete and total financial hibernation. Do not make any changes. Do not buy a car. Do not buy a boat. Do not buy a stick of gum on credit if you can help it. Do not open any new credit cards. Do not close any old credit cards. Do not co-sign a loan for your cousin. Do not switch from a 2-year phone contract to a monthly plan. Do not change your bank accounts. And for the love of all that is holy, do not change or quit your job without talking to your loan officer first. Your only financial mission during this period is to keep doing exactly what you were doing before. Pay your bills on time every time. Keep your account balances stable. If you get a large gift of cash from a relative to help with the down payment, document it properly with a gift letter. Don't just deposit $5,000 in cash into your account. That screams undisclosed loan or money laundering to an underwriter. You must be a financial ghost. Be boring. Be predictable. We've covered a lot of ground in this series. We started with the simple foundational mistake of not knowing your credit score, the very number that dictates your financial life. We talked about the trap of shopping for a house before you shop for a loan, a cart before the horse mistake that leads to heartbreak. We uncovered the hidden costs, the property taxes, the insurance, the PMI, that turn a seemingly affordable mortgage payment into a monthly budget breaker. We navigated the murky waters of choosing the wrong loan type, of getting suckered by teaser rates, and of not getting multiple quotes from different lenders, a mistake that can literally cost you tens of thousands of dollars over the life of your loan. We exposed the danger of draining your savings for a down payment, leaving you with no emergency fund for when the water heater inevitably explodes a month after you move in. We talked about the subtle but crucial errors in your application, the little white lies or forgotten debts that can derail the whole process. We highlighted the critical mistake of not getting a home inspection, of falling in love with a beautiful house that's secretly a money pit of rotting foundations and faulty wiring. And finally, we've arrived here at the finish line, warning you against making any sudden moves that could snatch defeat from the jaws of victory. Each of these mistakes is a roadblock on the path to homeownership. But now you know where they are. You have the map. You understand that getting a mortgage isn't a single transaction. It's a marathon of meticulous planning, financial discipline, and constant communication. The goal isn't just to get the keys. The goal is to do it smartly, to secure a home that is a blessing, not a burden, to build wealth, not just acquire debt. By avoiding these common pitfalls, you're not just buying a house. You are taking control of your financial destiny. You're making one of the biggest investments of your life with your eyes wide open, armed with the knowledge to do it right. And that is the foundation you can truly build a future on. If this journey we've taken together has armed you with the confidence to take that next step, and if you want to continue making the smartest financial decisions of your life, then do yourself a favor and hit that subscribe button. Because as crucial as avoiding these mistakes is, what we're covering in our next video is the secret weapon of savvy homebuyers. The 7 negotiating tactics that lenders don't want you to know. You've learned how to get approved. Next, you'll learn how to save thousands. You don't want to miss it.